Welcome to the panel for homeowners focused on how to use your equity like a pro. My name is Jessica Monge Coria, and I'm with the Federal Reserve Bank of San Francisco, and I'm so excited to be here today with you. And I have four amazing panelists joining me that will be able to answer some of our questions about you own a home now and how to use your equity. So let me just start with some definitions, which is refinance and home equity line of credit. There are two different loan products that homeowners can use to take advantage of their equity. Julie, do you mind helping us just explain the difference between the two?
Sure. Thank you so much, Jessica. And Julie Davis with US Bank. So basically, when we think about wanting to pull equity out of our home for whatever reason, remodeling, buying a car, sending a kid to college, we have two options. We can refinance the existing mortgage we have, and that's called a closed-end mortgage. It is typically, for a 30-year term. And you're going to choose the type of program that you want, interest rate, all of those things. And in that process, we can ask for cash out, is what we call it in the industry. So we're going to actually pay off our first mortgage and receive cash out for whatever purpose we need it for, versus a home equity line. A home equity line keeps your first mortgage in place, and you're taking out a second mortgage, and where you are pulling equity, cash out of your home. And that type of the home equity loan is considered an open-ended mortgage. And that's because you can pull as much cash out at a time in increments as you want. So the loan will have a fixed amount. Let's say I need $100,000, but I may not need it right away. So the payment that's created by that second mortgage is only based on the amount that you take out and whatever that balance is. So that's why it's open-ended, and they are all adjustable rate. So that is also a factor when deciding. It's an adjustable rate mortgage, and it's amortized. Instead of over 30 years, it's amortized over 20 years. So the payment tends to be a little higher. So that's the difference between the two, is maintaining your first mortgage, taking out a second loan for that equity that you need, versus refinancing your first mortgage and taking the equity out at that time using your first mortgage.
Thanks so much, Julie. And for those of you who need interpretation, if you click on the global, it kind of looks like a globe icon. You can click on that, and it will allow for this panel to be live interpreted in Spanish as well. All right, let's move on to the next question. Orlando, if you can answer this one for me. As a homeowner, how do I know which option, the refinance versus the HELOC that Julie explained to us, is right for me?
Good morning, good afternoon, everyone. This is Orlando with Premier America Credit Union. Thank you, Julie. Thank you, everyone, for having me on board. It's a really great question. I would consider, obviously, all the options that are available. Number one rule that I tell everyone is shop around. Call 1, 2, or even 3 lenders and weigh out what your options are. So first, refinances are always a great option because you can obtain a fixed rate for a longer period of time. You have a lower payment because they're over 30-year terms. However, with today's rising rate environment, we're no longer on a 30-year fix or adjustable rate mortgage refinances in the low 3s or even below 3. We've all seen those rates have gone up considerably. So if you have a really good rate on your first mortgage and you want to do home improvements, finance college expenses, a number of things that you want to do with the equity of your home, you may not want to lose out on that low rate on your first. So that's why a lot of lenders and a lot of consumers, we look towards that second mortgage option. So that means we're not going to touch our first, leave that great rate alone, and we're going to go ahead and take out either a home equity line of credit. That's an open line of credit. Think of it like a credit card against your home. You're only going to pay on what you use. And those type of line of credits have a variable rate feature. So you have to consider if that's right for you if you're borrowing on a shorter term. And I say shorter term because today rates might be 4 or 5% for this line of credit, but in the near future, they can go a lot higher. So you want to make sure that you have the ability to repay those funds sooner. Or there's even the option of a fixed second mortgage. So these fixed second mortgages may range in a little bit of a higher rate, maybe 6, 7%. So it's a little bit cheaper than a personal loan, for example, because you're using a very low risk, which is the equity of your home, but it's a little bit higher than that variable rate line of credit. So I consider those fixed second mortgages good for someone like me who has a fixed income. I don't want to be impacted in my finances if my second mortgage now went up $400 a month. That's a pretty big jump on a variable rate feature. So the second fixed mortgages, it's nice that it's terms over 15 or 20 years. So they're shorter than a refinance. So the payments are going to be a little bit higher, but the benefit is that you're paying off that second mortgage a lot sooner than your first mortgage. So also you want to consider how much you're borrowing. So let's say on your first you have 500,000 and you really want to borrow 30, 40, 50,000. That's why you don't want to increase the rate on such a large sum in your first mortgage for a smaller sum on your second. Now, let's think a bit of the reverse. Those of us who maybe purchased a home a long time ago, we really only owe 100,000, 200,000. We have the pleasure of paying off our home in the next few years, but we want to build an ADU, right? Mom is coming, or our kids just had a family and they can't find a home of their own. Why don't we build or add on to our home? That may need 200,000-300,000 in a new mortgage. So in that case, I would go back to considering a refinance, even though you're losing out on a higher rate on your first mortgage. Just because your first mortgage balance is lower than what you're taking out, you may want to consider what's best overall. How are you going to save in the most amount of interest for the next 30 years? And what's going to give you the best payment, most affordable payment? So those are the things I would consider.
Thank you so much, Orlando. That's a lot of really great information to think about when you're kind of looking at those different options. Ricardo, turning to you, with any financial product, we know there's benefits and risks. Can you just tell us about, as a homeowner, what we can consider before applying for a loan connected to the equity in our home? What are some things we should think about? Oh, you're on mute. Ricardo, you're on mute. Oh, there you go. Oh, now we can't hear you. Well, we'll work on the technical difficulties there. Yeah, we're still not able to hear you. Julie, going back to you, are there some things that you think a homeowner should consider, before they apply for a loan connected to their equity?
Yes. So much like Orlando was talking about, it really has to do with the overall goal. Why do I need the money? What is it for? Do I have a low interest rate on my first? And then the next step is speak to a loan officer, because they're going to be able to weigh the pros and the cons with you. And also sometimes it really just comes down to math. So what is my need for the cash? And something Orlando mentioned, is it for a short amount of time? Is it a low loan amount? Those are all questions and to ask and get advice on. So if I know I'm building a place in my backyard for my kids, also called an ADU, that is going to run me several $100,000. I'm not going to pay that off within a short amount of time. If I know this, that's the time to consider refinancing versus a home equity line. And one of the things that we've been talking a lot about at US Bank is when we're consulting with a borrower in this situation, it's important to look at the interest rate on the first, the interest rate that would be in a home equity line of credit, and do a combined rate. So we need to know, what is the savings? If I choose to refinance, here's my rate, here's my payment, here's the pros and cons. If I decide to take out a home equity loan, same thing. Here's the rate. It will continue to go up. It's probably a larger payment, but what are the pros and cons? I've had customers who were in the situation, they needed that home equity line, and yet they knew in a short amount of time they would be able to pay off that home equity line. Then there's your decision. If you know you're going to be able to pay off a home equity line in a shorter amount of time, then you don't want to refinance your first mortgage. You have a good rate. So all of these factors are things a homeowner needs to consider. And some of it may seem confusing, which is why a loan officer can help you sort it all out. I know in my practice, I literally, because I'm visual, we will do a pro, we will do a con, here's the math for this, here's the math for that. And suddenly the decision becomes apparent, right? So it's really just making sure you're making an educated decision, that you have all the facts, you know the difference, and you can see clearly what's going to benefit you financially.
That makes a lot of sense. No two borrowers the same, and no two homes are the same, and no two options. So you're really going to have to make it that specialized in terms of what works best for this individual or household. Anything else you wanted to add, Orlando, on that, when you're kind of weighing the pros and cons?
Yeah, absolutely. Julie had a lot of great points. One thing I will add, it's completely free to talk to people like us here on this panel. So that's why I say use your resources. It's the biggest risk is your lack of information, right? It sounds silly, but I think what you don't know will hurt you the most. Again, be careful with variable rates. If you're going to look towards purchase or paying it off over long term, you may want to consider some fixed rates right now, because we are in a rising rate environment, and that could change in the future. But let's make decisions and assume based on what we know today, and start early. Most of us lenders were really busy with refinances, and refinances made more sense than taking out second mortgages. However, now that things have changed, now that first mortgages have increased, I personally took out a line of credit recently. I called all my friends, I called several different banks to weigh out our options, and I noticed the same thing. We are busy with the second mortgages. It's making more sense today. So don't go to your bank when you need something within 3-4 weeks. You might get lucky, and great banks like US Bank or other large lenders may process them quickly, but maybe give yourself about 2-3 months time in the process. Now, second mortgages have a little bit more limited paperwork than maybe a first mortgage, but there's still, think of it of just waiting in line in the grocery store. There's just more people in line based on what's going on today. So that's one bit of advice. Start early.
Start early, ask several people. I thought that was really great advice to Orlando, to shop around. And we have yourself and Julie and others at this on this conference today who now you know who they are. You have a face with a name. You can give them an email or call them up. So my last two questions are, I know Gabriela is an expert in these two, so I wanted to turn to her for these. Specifically thinking about seniors, what resources do our seniors who are, on a fixed income, might actually have a lot of equity in their home? What resources do they have that they might want to consider?
So Orlando just mentioned the word reverse mortgage. So as a senior, you might need to tap into your equity, whether it be because you've now retired, Social Security income might not be sufficient enough to cover the mortgage that you're still paying on, or just your household expenses. Or maybe you have children who live with you that you support. So through a reverse mortgage, it's exactly what it sounds like. It's a reverse of a mortgage. You no longer have a payment. You still have to pay for property taxes and insurance, but there's ways to tap into that equity in different forms of payments where you can actually get money out. There's fixed and there's adjustable rate mortgages, and each of them have their pros and cons. As we've been mentioning with refinances, HELOCs, any kind of mortgage product has their pros and cons. So we need to really weigh them out. In this particular sense with reverse mortgages, with a fixed rate, you can take a lump sum, take it, save it, and use it as you need to manage it. And that's where a big overarching topic with, again, all other 3 products or 4 products with the second mortgages that we've been mentioning is budgeting. It's huge. Need to know what you can and can't afford. With the adjustable rate mortgage on a reverse, you can actually get monthly payments to support you for the rest of your life as long as you're living in the home. So we can add to that income that you have from Social Security or your pension or your investment accounts. And we actually can now stay in our home, be able to afford it without having to downsize. Or you can downsize if you like and still get a reverse mortgage. That is also an option, a reverse mortgage for purchase. So there's definitely options there, even for seniors that maybe a refinance financially is not possible with our fixed income, or the thought of affording a HELOC and the payment adjusting might not be secure for us, but a reverse mortgage is definitely there as an option.
Awesome. Thank you. Another question for you, Gabby, is what resources do homeowners struggling with mortgage payments have?
Definitely come across that quite a bit, especially right now with people exiting forbearances or just simply having a COVID effect that's now lingered through. So there's different programs through the state of California. There's one in particular that you're able to actually get your past due balance paid for by the state through a grant up to $80,000. California Mortgage Relief Program. Excellent program. There is some criteria in order to qualify. And we're going to be having actually a workshop on this. So please make sure to join us for our home preservation class. But that is one resource, the state, and then connecting with your servicer, who it is that you pay your mortgage to. They're your first go-to to find out, what does my loan have as an option? Because no 2 loans are the same. So connecting with them, we can actually figure that out, or connecting with someone like me as a HELOC counselor. That's what we're here to do, is figure it out with you and guide you through that process. So
great. Thank you so much, Gabby. Ricardo, do you have audio now? I want you to at least be able to introduce yourself if you do.
I hope so. Are you hearing me?
Yes. Okay. Go ahead.
Hi, my name is Ricardo. I've been with the VCCDC since 2019. I've been in the mortgage business for over 20 years. And, this is right in line with what I've been doing for a long time, which is helping first-time home buyers. VCCDC, of course, offers the additional funds that I didn't have, obviously, when I was working somewhere else. So this is a great plus, especially with this environment. Interest rates, home prices, a good majority of the people that I talk to are in that low-income category. So it's a challenge, but we put our heads together and we look to try to offer all the best options that we can, to help clients realize home ownership.
Great. Thank you, Ricardo. Thank you for being here. He's another resource that we have at VCCDC for all of our attendees today. So I'm glad you were able to join us. Julie, we have a question from the audience that I think you might be able to help us with. The question is, I've heard it's a good idea to hold an open HELOC as a way to access cash, especially if there's a job loss or some, temporary unemployment situation, maybe. What's your opinion about this? Do you know, does it affect your credit?
So that's a great question. And Orlando, I'm sure you're finding this as well. We at US Bank are doing a lot of home equity loans right now. And based on a number of factors. So we have the economy, and we have an impact to certain industries, job markets. So when we think about the future, and if there's any kind of concern about budgeting resources, for some of those reasons, we have customers taking out a home equity loan just to plan ahead. If they foresee any hardship, especially, or next year they see a large expense, and they're unsure if a year from now they'll be able to qualify for that home equity loan. Those are reasons to think about it. Do I think it's a good or a bad idea? It's needs based. So I don't think it's a bad idea if we're worried about the future. However, as long as you don't draw on that line, you don't have a payment. So a lot of customers right now are taking out a home equity line, and you're deciding up front how much you want your line to be, and it's going to sit there with a zero balance. So you're not incurring any payments, any expenses around that home equity line. So it kind of like a safety net is how I look at those equity lines. It's probably something to think about now before we have any impact to the possibility of lower home values, a changing market. Maybe my position is going to change. So if you're in a good position right now and you can foresee needing access to cash, it's a good option.
Great. Thank you so much, Julie. I think what we've gotten today is that there's a lot more options than even the two we started out with. I think we actually mentioned 4. Planning ahead is really important because things aren't going to happen necessarily overnight. So this isn't the type of, access to capital where you need it tomorrow. You're going to be able to take advantage. Make sure to shop around and ask lots of questions. You have resources at various organizations, 3 of which are represented on today's panel: U.S. Bank, Premier America Credit Union, VCCDC, to ask those questions, to go through that pro and con list with you before you make those decisions that are really important and impactful for your livelihood. But I want to close this out on time, but I have one last quick question that I think maybe Orlando, you might be able to help us out with, which is, what are the fees to get a home equity line? I'm sure they vary, but if you might be able to provide us some range or.
Absolutely, yeah. Without being specific with our fees at Premier America, I'll give ranges. So typically, as Julie said, if you're taking a line of credit just for emergencies, just to prepare for the future, because I will say, when you need that line of credit, it's like the worst time to apply. Like once you've lost your job, or you've used up your credit cards and now your FICO is lower, like you want to plan ahead and get it early. As Julie mentioned, if you're not going to use it, typically there are no fees. Now I will say, as you're shopping around interest rates, you might find one lender has a higher rate, but no annual fee, no fees up front. And then there's another lender that may have a lower rate, but they have an annual fee, $50, $100, $200 a year, or they may not pay for those closing costs up front. So we're all different as lenders. There's not one best place. If there was one lender that had it all, I would work there. That's not the case. So lenders are as different as people are, right? So shop around, talk to 2 or 3. It doesn't cost you anything, and get that information. Because if you talk to 20 lenders, you're going to find that they're all going to have variations. Now, what I was alluding to is, if it is something that you don't plan to use, you may want to not take so much out on a line of credit. So for example, a lot of lenders will give you a free line of credit, meaning they'll pay the closing costs, and closing costs entail an appraisal, whether it's done online or a full appraisal, title insurance to ensure that transaction. So some lenders may pay those $500 to $800 up front for you, as long as you keep it for 2 to 3 years, and as long as it's not a large amount. So usually when you go over 250,000, then that's when you're going to incur those expenses up front. So those are typical expenses between $500 to $1,200, and depending on those loan amounts. And then again, annual fees is something that you want to ask, and how long do you need to keep it open?
Great. Thank you so much, Orlando. Yeah, I think what we've also learned is that there is no one answer to each of this. So that's why you have to go and ask the questions to the professionals and make sure you have all the information before you make one of these decisions. Well, I want to thank you all so much for joining us today. And the next set of workshops begin in 12 minutes at 12:30. So we hope you will continue to join us today at the conference. And thank you so much for being here. Have a wonderful rest of your Saturday. Bye-bye.